Hi, I'm Jimmy. In this video, we're going to look at the fees of exchange-traded funds, or ETFs for short. Now, in this video, we're going to try to go beyond the typical ETF fees that many investors look at, and we're going to look at some ETF fees that are often more overlooked or more implied ETF fees. Then, towards the end of the video, I'm going to touch on some examples where it could make sense to pay higher fees. And perhaps the more insight we have, the more money we can make. The more money we make, the closer we can get to our personal goal, whatever that is, ideally financial independence. Okay, now let's start with a common fee, but in today's world can often be avoided completely, and that is commissions. A commission is a fee that our broker would charge us for executing the trade and for doing the paperwork behind getting us the shares that we bought or the ETF that we bought. But thankfully, a lot of that is automated these days, and many brokers are no longer charging commissions. And I think as time goes on, less and less are going to be charging commissions. So if our broker is charging us a commission, well, it could be time to talk to them about either lowering that commission, dropping it completely, or more likely, finding a new broker that doesn't charge a commission. So the commission fee is mostly avoidable these days. Okay, next, let's look at one of the more well-known ETF fees, and that is the expense ratio. So the expense ratio is how much the exchange-traded fund manager charges us on an annual basis to cover their operating expenses. Now, this is a short list of some of the largest ETFs out there. And we can roughly see how much assets they have in each of the funds, and the part we care about, how much their expense ratio is. This is the most popular ETF fee out there. And when oftentimes you might hear people say, an investor say, oh, their fee is blank. This is usually what they're talking about. Now we can see that these fees run from as low as 3 basis points to as high as GLD down here, which is 40 basis points. Outside of this, there are some ETFs out there that don't have any fees, and there are others that are much higher than these, but we'll just stick with these as an example for now. Okay, so obviously we want this fee to be as low as possible. Now let's look quickly at how ETF fees actually work to help us get a better understanding of where some other, call it implicit fees, could be hiding. So we're the investor, and we're going to go out and buy an ETF. Now, this is where we would be charged a commission if we're at a brokerage firm that has one. But let's imagine we're not being charged one, so we'll get rid of that. Okay, now this ETF is going to be investing in something. Maybe it's a bunch of stocks or bonds or commodities or whatever it is. That's what those circles represent. We're likely investing in the ETF because one of the advantages of buying ETFs is that it's like you're buying a whole portfolio all at once. So, let's imagine that this particular ETF has $100 million in it. Well, this ETF is managed by a fund manager. Maybe that's Vanguard or iShares or some other company, but either way, it's going to be managed by a fund manager. So when it comes time for that fund manager to get paid, well, their fee comes right out of the pool of assets that the fund controls. So if it's a 100 basis point fee, which is the same as 1%, well, that fund manager, since this fund has $100 million in it, they will get $1 million. We as the investors never see that happen since it all happens behind the scenes of the ETF. So obviously we want this ETF fee to be as low as possible. They call this fee the expense ratio. So we want to keep that in the back of our mind. Expense ratio, ideally no commissions, low expense ratio. Okay, simple enough. Now let's look for some other, let's call them more subtle fees or the more implied fees behind an ETF. So this fund manager is managing this portfolio of stocks. Now, let's say as time goes by, well, maybe they no longer want one of the stocks. Maybe it doesn't meet the rules of the fund or whatever it is. So they sell that stock. What do? Generally, they replace that stock with perhaps a different stock or a bond or whatever it is. Now, the odds are, even if we're not paying a commission up here, well, the odds are that the ETF fund manager is paying commissions to their firm. So down here, every time they buy and sell a stock or a bond or whatever it is in the ETF, well, there's likely to be commissions charged in those transactions, and that is not accounted for in the expense ratio. For that, we're going to want to look at something known as the portfolio turnover. We want our portfolio turnover to be as low as possible, because the more the fund moves in and out of different positions, the higher the turnover ratio will be. And ultimately, that will lead to more transaction costs like commissions. It could lead to higher taxes if the fund has to pay capital gains tax. There could be other fees tied to them moving in and out of positions. So they're going to define all of this in the company's perspective. But broadly speaking, we want a lower turnover ratio because that is likely to lead to less overall fees or overall implied fees that are not included in the expense ratio. Okay, simple enough. Now, this brings us to another sort of implied fee. It's not really a fee, but it's something that could end up costing us more. And that is known as the bid-ask spread. So when we go out and we buy a stock or an ETF or whatever the case is, this would hold true for both of them. You might get a quote like this. This is a quote for SPY. And as we can see, the bid for SPY is 322.05 and the ask is 322.06, just a penny apart. That's pretty good. But the higher this spread is, the more the broker makes, because what we have to remember is that if we were to place a market order and we say, okay, we want to buy a stock or an ETF at the market price, well, we buy it at the ask price. If we wanted to sell, well, we sell at the bid price. So you're always going to get, if you buy a market order, you're always going to get the worst price available. So we want this spread to be as low as possible. And generally, with the more higher liquid, more popular ETFs, this spread's going to be very, very small. But if we look at something like ARKG, well, we can see their spread is 3 cents. Then if we switch to LABU, well, there they have a spread of 5 cents. Now, I know this may not sound like a lot, but we are talking, this is 5 cents per share. So depending on how many shares we're buying, this could make a meaningful difference. And why pay a nickel more if we don't have to? Now, one way to get around this is instead of placing an order at a market order, you could do it at a limit order and try to close that gap a bit. Now, if you're a bit unfamiliar with this type of thing, with the trading side of investing, please let me know in the comments below. Perhaps I can do a video on some of the pitfalls that some investors run into when they're trying to place trades, or perhaps how to better maximize profits when trading in and out of a position. Either way, from the ETF standpoint, if we're investors for, let's say, the long run, perhaps the nickel a share doesn't matter all that much, but I still think it's worth remembering or at least being aware of, and then we can decide as we get into that position. So now to answer the question, does it ever make sense to pay a higher fee for an ETF? And I think the answer is absolutely. It can be smart sometimes. So let's start with this ETF. This is an ETF called Invesco Solar ETF, ticker symbol TAN. Obviously, they focus on the solar industry, but their fee is about 70 or 71 basis points, so 0.7%. Now, by today's standards, many people would look at this fee and say it's very high, but this is a very specialized ETF. And if we're interested in an ETF like this, if we're interested in investing in the solar industry, well, it could serve a very specific purpose in our portfolio. Well, if that's the case, I might be willing to pay a higher fee. This ETF, as an example, in 2019 has a total return of more than 65%. That's more than double what the S&P 500 did. Well, we could have paid 3 basis points for a S&P 500 ETF, or maybe we pay 70 basis points for this ETF. Well, hindsight being 2020, clearly this one would have made more sense last year. Now, I bring this out simply to illustrate that if we let our research lead us to a great potential opportunity for a sector or a group of stocks or bonds or whatever it might be, well, I wouldn't avoid investing in a particular ETF just because the expense ratio looks high relative to broad, very popular ETFs like SPY or any one of the Vanguard ETFs. Perhaps our research is correct and we're willing to pay a higher fee, and ultimately that gives us the broad access to a group of stocks or bonds or whatever that could ultimately lead to our portfolio outperforming. Now, recently, I've been spending a lot of time researching dividend stocks and dividend ETFs, and I've also recently done a review of some dividend ETFs where I went a bit deeper in looking at things like implied liquidity and things like that around ETFs. So that could be a good next video for you to watch. If you're interested, there's a link here and there's a link in the description below. And thank you so much for sticking with me all the way into the video. I really do appreciate it. Thanks, and I'll see you in the next video.